Happy Tuesday, everybody. I hope you had a good long weekend. Another short week, no Monday in the work week this week. Today is February 20th, 2024, and this is your Tuesday market update. Last week was a full, rich week, so let's wrap that up. Preview this week, short on days, but full on data. More on that soon. Last week's stocks started Monday trading flat after a quiet weekend of news. The New York Fed inflation expectations met expectations on the 1 year, but the 3 year actually fell from 2.6 to 2.4. Seems pretty close to that 2% the Fed's shooting for. Stocks did rally on that news, as that was one data point in the March rate cut camp. Easy to say. That lasted a bit until the pre-CPI positioning came along and profit taking brought things back near unchanged on the day. Geopolitics did not get much better as the Middle East is not getting too quiet. Recall that I have mentioned that we should keep a close watch on oil prices. Yes, the markets are watching what is happening, but at this point, with oil still trading below $80 a barrel, markets are saying things are not going to bubble over, at least now. By the end of the day, the Dow was up 1/3 of 1%, S&P down 1/10 of 1%, and the NASDAQ was down 1/3 of 1%. By the way, the Super Bowl hangover seemed tame, but not due to lack of eyeballs. As we discussed last week, now the numbers are in. Super Bowl 58 was the most watched television show ever. And before we move to Tuesday, two sides of the coin, good and bad. First, according to the New York Fed's household survey, 8.5% of credit card loans became newly delinquent in Q4 of last year. That's the highest since Q2 of 2011. And a percentage of credit used up to 23.5%. That's the highest since Q4 2019, right before COVID. Wow, that has been a long time since we referenced COVID. On the other side, S&P has rallied going into this week 21.3% in the past 70 trading days without even a 2% decline. It has happened only 15 times since 1953, and according to Bespoke Research, 12 months later, it was up 12.7%, gains 87% of the time. Okay, welcome to CPI Day Tuesday, and wow, it was a day. Warmer than expected is not what we were saying about the weather in Chicago these days. CPI came in warmer, some even called it hot. Stocks dropped at the open and yields rose. The dollar was strong. Markets did get stable after the air pockets were filled, then rolled back over, but finished off the lows. Just a reminder, the hot CPI print put a big gaping hole in the idea of a March rate cut. So can we look to May? Lots of debate. By the end of the day, the Dow and the S&P were each down about 1 1/3%. The NASDAQ was down a bit over 1 3/4%. So while it was red in a sea of recent green, it was not the bottom dropping out. Still did not even touch that 2% I mentioned about that current stats. Back to the New York Fed household survey, millennials have seen an 80% surge in their wealth from early 2019 to late 2023, and that is higher than the over 40 crowd. And one more quick reminder of pullbacks. Per recent LPL research stats, stocks pull back 5 to 10%, an average of 3 times per year, and 10% or more at least once per year. Please keep that in mind. By Wednesday, stocks were on the bounce back plan. Stocks were higher out of the blocks and tough. And though news flow quieted, the rally accelerated mid-morning on Fed head speak, and then help on into the close. Then held on into the close, closing near the highs of the day. The algos are getting whiplash, or not. That's why this happens. They don't get whiplash. They're the algos. Those computers that trade, and as they read the press releases, they can go from Tuesday sell to Wednesday buy and think nothing of it, and that's what they did. UK and Japan are now in a technical recession. Let's see if anyone seems to care. Overall, it was a bull move for the day, but tame. Dow was up under 1%, under 0.5%. S&P was up about 1%, and the NASDAQ was up 1 1/3%. Again, with all the wow going on in the news, you'd think the numbers were bigger. Thursday brought the markets to still take a run to recoup the losses from Tuesday. Stocks rallied on the open, and all of the eco data provided that the bad is good and good is good, and that's good enough to see more recovery in the markets. Retail sales news in the U.S. were bad, and markets like that helped to offset the hot CPI. Yep, the jobs were still solid. Philly and Empire manufacturing was up. Good is good. PPI positioning was there, but not so evident. S&P hit a new high, and there was no fanfare. To close out the day, the Dow was up almost 1%, S&P almost 2/3 of 1%, the NASDAQ was up 1/3 of 1%. Friday morning saw another about face. PPI was also on the hot side. Prices are sticky, and remember, even though they are rising by small amounts, they are still rising, and that does not help the home budget lines. Doesn't necessarily make them worse, but does not make them better either. Rate cuts now, maybe later in the year, a lot of talk about that. Stocks were down on the open as yields and the dollar are up again. University of Michigan numbers are out too. Sentiment still going up, a bit bit below estimates. Inflation expectations up a bit on the 1 year, steady on the 5 year. S&P down, and 53 S&P stocks hit new 52-week highs. Recall that this is not just a stock market, it is also a market of stocks. Oil's at the highest point since November, but still steady and below 80. Keep an eye on that. To close the week, for the day, the Dow was down 1/3 of 1%. The S&P was down 1/2 of 1%. The NASDAQ was down over 3/4 of 1%. For the week, the Dow was down 1/10 of 1%. S&P down almost 1/2 of 1%, and the NASDAQ was down 1 1/3%. And let's talk about this coming week. And like I said, short on time, but not on potential market-moving data. Let's start with earnings. Walmart, Palo Alto, Home Depot, and one everyone will be watching, really, NVIDIA. Last year, Apple was one that was the barometer of the market. This year, NVIDIA, and that is Wednesday. Some of the others will precede it today. Walmart and Home Depot already today. We'll also get minutes from the last Fed meeting tomorrow. Focus on the earnings, as I've been telling you. Fed is back in the news next week with PCE. For now, we'll get the Fed heads: Bostic, Jefferson, Bowman, Harker, Cook, Kashkari, Waller. Full slate. We'll also get some read on jobs and continuing claims, and finally the flash PMI for the look at the economy. So that's the week in review and the preview. Another market update in the books. As always, please remember that this is a small part of the real work we do with your goals. Let's put a rudder on the ship and drive towards reaching those goals. The markets often feel like they are rudderless. I hope this video helps a bit. Come back on Friday with another planning video, and please call with any questions. Have a great short week.